Taking a look at futures this morning, second to last trading day of the year. We, of course, have got a flat number for the Dow right now, just going negative by 2 points. S&P and NASDAQ are slightly lower as we head into the session. Tech and AI still dominating the market discussion this year. NASDAQ rallied nearly 22% in 2025, outperforming both the Dow and the S&P 500. Global semiconductor sales topping $400 billion in 2025. Chip makers bracing for an even bigger 2026 as demand for computing power is surging. NVIDIA facing some stiff competition from Google and Amazon even after they signed that $20 billion AI deal with Grok. Analysts are warning long-term AI financing, power, and supply constraints are emerging as a risk as we go into the new year. Let's bring in Piper Sandler Chief Investment Strategist Michael Kantrowitz. Michael, good morning to you. What are your thoughts on all of this as we look ahead?
Good morning. Well, I think there's a lot of reasons to still remain constructive on U.S. equities in 2026. I think we're beginning to see a sustainable budding rotation outside of just pure tech into other areas of the market, and that in 2026, positioning is going to be about the collision of the secular AI cycle colliding with a cyclical monetary and fiscal stimulus backdrop, which I think is going to be pretty good for macro. The concern next year is going to be whether or not interest rates on the long end and inflation pressures are restoked by better economic growth, and I think that's what investors are going to have to navigate next year.
Greg, get into this. Do you think that we're going to have that strong growth in 2025, especially after we had that incredible GDP reading for the third quarter?
I do, and I think Michael makes a great point. I mean, the question is, we have inflation running 2.5% to 3%. You've got growth running at a good clip, and I think the economy is in pretty good shape. So with regard to the long end of the market, it is questionable. I know the administration wants rates on the long end down, but the dynamics don't necessarily lend to that. So we have seen this steepening, and the steepening has really come from the short end with the Fed coming down. Michael, what's your outlook for the Fed in 2026?
Yeah, I think we'll see a few more rate cuts. So I do believe that we're going to have a unique macro backdrop next year that we haven't seen since the early 90s. And we saw quite often in the 70s and 80s, is a budding cyclical recovery while we are still seeing weak employment data or a rising unemployment rate. So the combination of a softer labor market persisting into 2026, I would argue, and have been arguing, that continues to be a bullish story for equities because it keeps the long end and inflation pressures contained. It allows the Fed to cut a few more times while we are seeing areas in the economy like housing and manufacturing start to actually show some signs of healing. So I think it's a pretty good yet unique backdrop next year.
Let's talk about the Fed a little bit more, because as we close the books on this year, 2025, and we take a look at the 2-year right there, here you go, and of course the 10-year, you've got this Supreme Court decision on President Trump's tariff authority. And also, of course, we're watching to see who the next chairman of the Fed is going to be. Now, on the SCOTUS issue, I want to ask you about that, because certainly with companies that are basically have filed already suit, they want refunds on tariffs if the court throws it out. You've got that issue, and then also President Trump is putting more pressure on the Federal Reserve. He's saying he'd love to fire Jerome Powell. The question I think now is, does Jerome Powell quit instead of staying through 2028 as he at this point is scheduled to do? Michael?
I'm not concerned about Jerome Powell quitting in the near term. I mean, he's certainly made it this far. So, whether or not he'll stay on the FOMC, we will see, and that'll be interesting to see how markets react to that. Yes, the new Fed chairperson is going to be able to and likely will cut rates further. The long end, to me, is really going to continue to be a function of the labor market. So, we do want a strong economy with a strong labor market. I don't think that's the backdrop. But again, I think a combination of softening labor data is going to be something that has and will continue to keep long-term interest rates lower. So, I think the macro backdrop is going to play a bigger role than who's in the seat of the FOMC next year, like it's been the case, I would argue, for the last couple of years.
Well, no, because this, a strong economy kind of complicates, the Fed's decision making, and the outlook for next year. And there's a lot of pressure on Powell, and of course we're going to get a new Fed chair, but he's only, that's only one person. How you lead the Board of Governors and how you lead the committee is going to be another. Michael, it's always great to see you. Happy New Year. Thanks for being here.